Everyone who has ever given you advice about retirement has probably told you some version of the same thing. Hold on to what you have. Don't make big moves right before you stop working. Keep your house. Keep your insurance. Keep your investments in place and let them do their work. It is good advice, most of the time. And it is the advice that quietly costs some people hundreds of thousands of dollars because what they are holding is not always what they think it is. Beverly is 62 years old. She lives in Sacramento, California, and spent 24 years as an HR director before deciding to take early retirement. She had done the planning. She knew her Social Security strategy. She knew her Medicare timeline. She and her husband had a meeting with their CPA every spring. She felt, as she walked into an AARP retirement planning workshop on a Tuesday afternoon, like someone who had thought through most of the important questions. The workshop leader, a retirement planner who had been doing this for 19 years, went around the room asking each person a single question. She asked Beverly, "What are you still holding that you no longer need?" Beverly went quiet. She thought about it for longer than she expected, and she realized, sitting in that room, that nobody had ever asked her that question before. Not her CPA, not her financial advisor, not her husband, not the retirement planning articles she had been reading for 3 years. She had been so focused on what to accumulate that she had never stopped to ask what to release. Here are the 5 things Beverly found when she finally asked. The first is the second car. The average American household with 2 vehicles spends approximately $24,000 per year on the combined cost of ownership, insurance, maintenance, registration, depreciation, and fuel. According to AARP's most recent driving cost study, that number is not a typo. It is $12,000 per vehicle per year. In costs, most people do not add up because they pay them in small amounts spread across 12 months. Beverly's household had 2 cars. She drove to work 5 days a week. Her husband, who had retired 18 months earlier, drove to the grocery store, the golf course, and the occasional lunch. When Beverly retired, neither of them would be commuting. She went back through the last 3 months and counted the number of days both cars had been needed simultaneously. The answer was 3. In 90 days. 3 days when they actually needed 2 cars at the same time. Before you sell this one, ask yourself, how many days in the last month did both people in your household need a car at the same time? If the answer is fewer than 5, run the calculation. Take the current market value of the vehicle you drive less. Beverly's was $14,000. Add the annual cost of ownership, and put that number next to what else it could do in a retirement account. Beverly redirected the sale proceeds and the annual savings into a catch-up IRA contribution. At 62, the IRS allows you to contribute an additional $1,000 per year beyond the standard limit. It is not a fortune, but it is not nothing either. The second is the life insurance policy you no longer need. This one requires a specific question. What exactly is this policy covering? When Beverly bought her whole life policy at 38, her children were young, her mortgage was large, and her husband had a lower income. The policy made complete sense. 24 years later, her children are financially independent. Her mortgage is paid off, her husband's pension covers their baseline expenses, and the policy is generating a cash value of $67,000 while costing $3,800 per year in premiums. The math on this one is straightforward. Who depends on your income today? If the answer is nobody, if your spouse has their own income or pension, if your children are independent, if your debts are paid, then the death benefit may be protecting something that no longer needs protecting. The premium you are paying is a cost you are carrying into retirement that may not be doing the work you originally bought it to do. Beverly's CPA presented 2 options: a 1035 exchange, a tax-free transfer of the policy's cash value into an annuity, or a surrender of the policy for the cash value. They ran the numbers. The $3,800 per year in saved premiums, reinvested over 10 years, produced a more useful retirement outcome than continuing to pay for coverage she no longer needed. Before you make any move on an insurance policy, talk to a fee-only advisor who has no commission interest in the outcome. The right answer is different for everyone. But the question, what is this policy actually covering today, is worth asking before retirement, not after. The third is the timeshare. Here is the question most people skip. When did you last use it? And do you know what you paid in maintenance fees last year? Beverly had a timeshare in Lake Tahoe that she and her husband had purchased for $22,000 17 years ago. They had used it twice in the last 6 years. The annual maintenance fee was $1,800 and had increased every year for the past decade. There was no realistic prospect of selling it on the resale market. Most timeshare resales go for $1, if they sell at all. Beverly had been paying $1,800 per year for the right to take a vacation she was not taking. The exit process for timeshares is not quick and not always free, but there are legitimate paths. Some resorts have deed-back programs. Some will accept a surrender, and some will negotiate an exit as part of a goodwill gesture. Beverly contacted the resort directly, explained that she was retiring and the timeshare no longer fit her situation, and after 2 conversations, was offered a deed-back option that cost her $300 in processing fees to exit a perpetual obligation that had been costing her $1,800 per year. The goal is not to get money out of a timeshare. The goal is to stop the obligation before it follows you into retirement. The fourth is the business stake or partnership interest that is no longer serving its purpose. Beverly owned a 15% stake in her brother's landscaping company, something she had purchased in her early 40s as a way to support him when he was starting the business. The stake generated approximately $18,000 per year in KE1 income, which flowed onto her tax return and contributed to something her CPA called the net investment income tax, a 3.8% surcharge on investment income above certain thresholds. The income also added complexity to every tax year, required her to be listed on the business's liability insurance, and meant she had ongoing financial exposure to a business she had no operational role in. Run this number before you decide. What is the stake actually worth today, and what does it cost you annually? Not just in fees, but in tax complexity, in liability, in the mental overhead of being part of something you are not actively managing. Beverly and her brother negotiated a buyout. He bought her stake back at fair market value, determined by a simple business valuation. Beverly received a lump sum, simplified her tax return, removed herself from the liability insurance, and invested the proceeds into an account she had full control over. The net effect on her retirement picture was meaningful. The fifth is the house that is too big. This is the most counterintuitive item on this list, and the most personal. Beverly and her husband owned their home in Sacramento, a 4-bedroom house they had purchased for $210,000 in 1998 that was now worth $680,000. 3 of the 4 bedrooms were empty. The annual cost of maintaining the property, taxes, insurance, utilities, repairs, was approximately $18,000. There is a provision in the tax code that allows married couples to exclude up to $500,000 in capital gains on the sale of a primary residence. Beverly's gain, if she sold today, would be approximately $470,000. Under current law, the entire gain would be tax-free. There is also a rule called step-up in basis that applies when assets are inherited rather than sold, meaning her children could potentially inherit the home at its current value, eliminating the capital gains tax entirely. Whether it makes more sense to sell now or hold depends on Beverly's specific situation, her income in the year of the sale, and how the sale proceeds interact with her Medicare premium and Social Security timing. It is the one item on this list where the right answer is genuinely different for every family. Before you sell this one, ask yourself, is this house right-sized for the next 20 years? Not just financially, physically, emotionally, and practically? The $18,000 Beverly was spending annually on a house whose rooms she no longer used was money that could have been doing something else. That is the question worth sitting with before retirement, not after. The home decision is the most personal on this list. A fee-only financial advisor can model the specific numbers for your situation, including how the sale interacts with your Medicare premium, your Social Security timing, and your tax bracket in the year of the transaction. Beverly walked out of that AARP workshop with a list. 5 things. She did not act on all of them immediately. She did not sell the house the following week or surrender the insurance policy the day after. She evaluated all of them deliberately, with the right people, with enough time to make each decision on her terms. That is the difference between someone who retires knowing exactly what they have and someone who discovers what they were carrying only after they have already stopped working. The second car, the life insurance policy, the timeshare, the business stake, the house. 5 things that look like assets until you add up what they cost to hold. None of them is wrong to own. All of them deserve a deliberate answer to the question Beverly was finally asked. What are you still holding that you no longer need? The years just before you retire are the years when you still have the flexibility, the income, and the options to answer that question on your own terms. After retirement, some of those options narrow. The best time to evaluate what you are carrying is before you put it down. If this video gave you one item on that list worth thinking about, subscribe so you do not miss the next one. Every week on this channel, we cover the financial decisions that matter most in the years around retirement.